lives. Moving on, we have Jonathan Charat and Kate Stilwell with the evolution of parametric insurance through big data and some products currently in the market. Jonathan is the Vice President and Emerging Solutions Director at Zurich, where he identifies emerging risks, evaluates potential solutions, and creates teams to develop insurance propositions. Kate is the founder of Jumpstart Insurance, which brought parametric insurance to consumers starting with earthquakes in California. Jumpstart is now a division of Neptune Flood, where Kate is the president of Parametric Insurance. Kate, are you starting off? Pass the floor to you guys.
Sure. I think it would be better if Jonathan started off.
Thank you. So let me just share my screen and we'll be able to begin. So thank you everyone for finding time to join us today. We're excited to talk to you about parametric insurance. In my slide deck, I'm really going to start with giving an overview of parametric insurance, a little bit of the history, go through the ideas of insurance protection gap, some caveats of it, and then ultimately talk about Zurich's construction weather parametric. So the insurance industry continues to go through an evolution due to new risks and technologies. The industry needs to continue to grow and adapt our offerings in order to meet the needs of our customers and broking partners where, when, and how they actually want to be served and be insured. So we need to make sure that we look for ways, traditional, non-traditional, all different methods of how we provide a very nice customer experience for our customers. Because ultimately, if your company don't do that, some other company will. So we always need to be very customer focused in this industry. So as a brief overview of parametric insurance, parametric insurance is a type of insurance that does not indemnify the pure loss, but ex ante agrees to make a payment upon the occurrence of the triggering event. For the uninitiated, its name can help define it. Parametric insurance sets parameters around a set of metrics. With a parametric insurance contract, a party is buying a predefined amount of protection, which will pay out based on predefined terms. The payout terms are the key here with parametric insurance featuring these triggers. The trigger mechanism defines when the contract is to pay out to the protection buyer. This trigger is typically based on parameters directly related to the risk that the protection buyer seeks to acquire coverage against. These could be, some sort of like a cat cover, potentially non-cat weather related, or even there's some more exotic types of covers like public image or things for cyber and other areas like that based on tweet scores and so forth. Overall, the potential of parametric insurance products is it expands the potential of what can be insured, and therefore it could fill some protection gaps that traditional policies do not respond to. Or said another way, we're casting a wider set of potential solutions that our customers could find and find some value in. So as we are a group of actuaries, there's always the questions about pricing, which is one of our two main areas of focus within the insurance world. And so pricing ultimately is what makes a solution work as insurance is that the relative uncertainty of any relevant trigger. For example, an insurer or an insured or no one in the value chain has any control over the arrival of a Category 3 hurricane or any other event that we're insuring against compared to everyone else. So no one has control over these objective numbers. And we're really replacing any subjectivity within the insurance pricing and claim handling process with objectivity. Further, the pricing of these insurance structures are very mathematical in nature, especially when we're discussing weather and cat triggers, with more data constantly being generated and more satellite imagery possible from NOAA, NASA, and other public sources, and even private sources. We really are able to start pulling more and more data to ultimately create these value propositions. And ultimately, when any customer is on their insurance customer journey, there will either a claim policy closes or we get to a claim. when we get to a claim, that's a very important part of any customer journey, because that's a point where if an insurance company does not handle the claim in a good manner, there is a very high likelihood that that customer is going to non-renew and go somewhere else. So with parametric insurance, there is a very good benefit in that, in addition to being able to insure something that may not have been insured in the past, it also has a potential for a really quick payout. The trigger of the insurance, the trigger of the insurance contract provides certainty that when conditions are met, a financial payment will be made. Parametric insurance is a vital proposition this way for providing a way to secure protection against precisely the conditions that affect or threaten your business. So it's the utmost important that both the insurer and the insured understand what those conditions are to make sure that both parties are keenly aware of how it relates to the potential financial, economic, or even damage losses to the protection buyer. So this is important in order to create a quick and clear claims process. So I know I talked a lot through that slide. The next slide will be a little bit faster, but we definitely need to make sure there's time for both for Kate to talk through all of the interesting things that her company is doing. So parametric insurance, when we think about it, it really started a lot more in places like India and East Africa, and places even Southeast Asia, with places where we really look at crop insurance, how it was done there. And it was a lot of times on a rain indice or these other indices, because if someone had a small farm, it could be extremely cost prohibitive to send a claim handler to that farm to actually to investigate all the losses. It was a lot more cost effective to those insurance companies as well as to the customers, that they would say if it did not rain, there would be an automatic payout. We also see a lot of cat bonds are really parametric triggers as well. But with more data being available, public sources, private sources, and so forth, we are able to really expand what is possible with the ideas of parametric insurance. Overall, regardless of the data source, the common denominator is a verifiable and objective trigger that both the insurer and insured could agree is a correct measurement for events. When we just take a step back and think about all the potential of parametric insurance, we're really right now just looking at on this graph on the left side from the Swiss Re Institute. They are talking about nat cat losses in the dark blue line, and the pink or magenta line is the insured loss. So that difference in there is, the difference in your economic loss versus your overall insured loss. So it's a mix of people who are companies who have not purchased insurance because there was no insurance possible, there was no proposition that they found interesting, or there's also cases where various institutions chose to retain the risk themselves. But some examples: 5 out of 6 homes in the US do not have flood insurance. If we go in Mexico, about 70% of vehicles don't have motor insurance. In China, out-of-pocket expenses for healthcare are hit 193 billion, 3 times the insurance coverage. If we look at the Philippines, 97% of typhoon losses in the Philippines are not insured. So across all sorts of cat, non-cat, weather, even health insurance, there is big gaps between what the actual economic losses are versus the insured loss. So it's really saying that there's a lot of potential in this space to fill those gaps. So the next couple of slides is really just trying to show all the variety of weather events that we had in the US. There would be similar varieties in Asia and Europe, regardless of the region. But if we just look at here in the US, we have these pictures of, here's 2020, and this is what it looks like in 2021 for the first 9 months of the year. We see that in 2020, there was 22 events, which is of a CPI adjusted $1 billion going backward, back through time. 2018 to 2020, we had about 16.7 events per year at about 78 billion per year. The 2010s, about 12 events per year, 81 billion per year. 2000, 6.2 per year and 52 billion, and so forth. Well, so the numbers are just, as we go further back, even though these are CPI adjusted, we see that the cost per year or the average loss per year has been increasing pretty heavily over time, as well as the number of events. So it shows not just the potential of climate change impacting these, but we also know of migration patterns where people have moved to the southeast, to warmer climates where there are more hurricanes. So as people start developing those areas, there is more insured losses there, and therefore more potential. But it doesn't just take these billion-dollar events to cause damage. If we look at how climate change is impacting the loss potentials, on the left, we have a view of heavy precipitation. So extreme precipitation has been increasing over time. Scientists expect this trend to continue as the planet continues to warm. Warmer air can hold more water vapor. For each degree Celsius of warming, the air's capacity for water vapor goes up about 7%. And an atmosphere with more moisture can produce more intense precipitation events, which is exactly what we have been observing. Increased heavy precipitation may not always lead to increased total precipitation for a given season or a year. So if we look at this graph, or this chart, excuse me, in the map, we see the New England, that's 71% increase. It does not mean it's raining 71% more. It means there's 71% more hail events now than they had 60, 70 years ago from their data sets. And these are heavier rains. Now, what makes this a big issue is we also have more urban development in New York City or in Singapore and places like that, which means there is less natural drainage. There is more potential for, there's less places for natural runoff. So you have a greater potential for flash flooding, greater potential for standing water, and so forth. So this is one of those places where this climate change impact of rain could have extreme amounts of insured loss and potential for new products in those areas if you, compared to the past. On the right side of this, we are talking about average annual temperatures, and we see from this that the average annual temperature in the US has increased about 0.7 degrees Celsius when we look at the 1986-2016 period versus 1901-1960 period. And from this, we also see that there is the frequency of cold waves have decreased in general over time, and the frequency of heat waves have increased. And one thing to keep in mind is just because the midpoint moves up about 0.7 degrees there, that does not mean that the tails have moved up by that same amount. The tails have increased by a few degrees Celsius, and that's where the big concern is when all of a sudden, just due to the distribution of how the data set falls for temperatures, that movement of the center has increased what a 95th percentile event is, what a 99th event is, by a couple degrees Celsius. And that is when it gets extremely dangerous. And now you can start seeing places where it's not safe to work outside, it's not safe for this and that. And you have new types of economic losses and actual potential for workers' comp claims and other sorts of health issues that could pop up due to these outdoor working conditions. Now, with all that said, there are really interesting parametric insurance products that are in the market, like this Ecological parametric insurance product that came from the Nature Conservancy, where they're actually using parametric insurance to help insure coral reef system in Quintana Roo, Mexico. It actually paid out last year, and that the premiums are paid by the government as well as the local government, as well as by local businesses. The idea there is they need the reef in order to encourage tourism. So yeah, these companies also have insurance against their own properties, but if the reef is damaged, people are not coming down there to spend money to go scuba diving, staying at the hotels, eating at the restaurants, and so forth. So they created this policy that then the money went straight towards the Nature Conservancy, who then used the entirety of that money to hire marine biologists and other people to help remediate the reef, help repair damages, grow pieces of the reef, and then reattach them, later on. So there's really interesting opportunities there. not just for what your typical ideas of who an insured could be. The idea of an insured could even be expanded within parametric insurance. Overall, there's some caveats to consider. And I'm going to be speaking from a US perspective here. There may be different laws and regulations in your place of domicile, and by all means, you're going to have to make sure that this holds true with you. In the US, we need to claim a loss. So parametric insurance should not be confused with a financial derivative. So one way to ensure that is the requirement that the insured suffer a loss and provide some sort of attestation when filing a claim. Secondly, there's indemnification limits. Again, we cannot over-indemnify a customer because then it falls into being a financial derivative. And there are tax implications for derivatives that are different than for an insurance product. If you look at the cost of parametric insurance, you see some places, sometimes you may hear people say it costs more, it's more expensive, it costs more. But I think that's not really, it's really insuring something completely different than a standard insurance and indemnification policy, because you're insuring against a specific event, which means you could adjust what the trigger level is, you could adjust what the amount of deductible is and so forth in a very transparent way to get to a price and level of coverage that makes sense for your customers. And ultimately, if you are doing parametric insurance, you could do it to indemnify or to pay against, some physical damage in other areas like that, but also could be used for this idea of NDBI, non-damage business interruption. And it could be used as a way to really round out a customer's coverages. And that's what I'll be talking through with the Zurich example. But before we get there, as I mentioned, there are weather-related, cat-related, which could be non-cat-related weather, cat type of parametrics, as well as what I've called exotic ones, which you see some companies do things on Twitter APIs, footfall traffic, cyber offerings, and so forth. But for the sake of time, we're not going to spend too much time there, and I'll just spend a minute or two talking through the Zurich construction parametric. So here we really started by trying to understand the customer problem. And that was that there's extreme weather events and result in costly delays in a construction project. So the owner may incur these soft costs and financing expenses, penalties, have to rent equipment. They may not be able to have their tradespeople actually work because it's raining too much and so forth. And due to climate change, these extreme weather events are occurring more frequently, which makes it a little bit more difficult for the insureds to really manage their portfolios and to operate their business in the most efficient manner. So this idea was to really put together this solution for climate resilience to our customers and think of it as a companion to our builder's risk, but also as a way to potential growth for Zurich. But we're not viewing success based on how much premium this is. It's much more of how does this help complement the risk management strategy for our customers. And that's really how we're driving success in this. The idea is we have some ideas with our customer feedback, what we've discussed, but for the sake of time, I'll just let you guys read that. And the way that we really view this is we looked at a few different perils. And we view that as I mentioned, the owner may incur these additional soft costs and so forth. So currently the costs associated to those, if something like, additional rental fees and so forth, if there's, are not really covered by builder's risk, or you guys may call it CAR and EAR coverages. So there's these, if there's no damage to the property, there's really no coverage on those traditional policies. So we're looking at, cold. If it's too cold for a crew to work outside, too windy, safety regulations may not let people do a critical lift with a crane, too high heat, it's not safe to work outside, too much rain, it might be difficult to pour a foundation, or they're going to have to pump water out of the hole that they've dug. And all of these are fully customizable in a way that the insured could let the insurance company know what perils they are interested in, at what level, so how much rain would cause an issue for them, and what times of their project would, like these specific weeks of our project, we're caring about rain. These specific weeks, we care about heat. And then we could really customize solutions for them. So I know I went through the last few slides relatively fast, but I know that I'm trying to make sure we all have enough time for myself and for Kate, as well as your questions. So I will be around for questions at the end of this presentation, and thank you all. Kate, off to you.
Thank you, Jonathan. Really appreciate it. And I'm just pulling up my slides here. And, you know, the three things that I want you all to remember from these presentations about parametric is one, that it is an if-then proposition. If there is the event, there is a predefined amount of money transferred. Second thing, the event that triggers the transfer of money, the if-then, is based on objective data, objective parameters. That's why it's called parametric. And third is that parametric is best suited for protection gaps where the insureds would otherwise not be available, the insurance would not otherwise be available, or that the insureds opt out. So those are the three main topics. And how parametric functions in economies and societies is like economic stimulus, either at the large scale, the macro scale, or at the micro scale. Economic stimulus to exogenous shocks, but economic stimulus from the private market. So if I had to stop there, I would be happy with what you're taking away. Those are the main takeaways from this session. And it's at the risk of repeating what Jonathan already said. So speaking of objectivity, with earthquakes, which is the first thing that we created parametric insurance for consumers, there is objectively known scientific data about the probability of occurrence, and therefore the probability, if there was a parametric product like ours, that would be paid out. And yet there also is this very specific protection gap where, just as Jonathan said, 5 out of 6 people in the United States are not covered for floods. About 8 out of 9 people in the earthquake-prone areas of the United States are not covered for earthquakes. So objective data plus protection gap. Likewise, in the Pacific Northwest, objective data, large protection gap. Thus enters parametric insurance, which I just explained. There is a specific event, oftentimes a weather event, because it has this objective data that initiates the disbursement of funds from the institution to the insured. And it's made possible by the existence of the data and the existence of the payment mechanisms, so technology and data. And so the concept of parametric is not new, but it's really taking hold, not just at large scale macroeconomic type of transactions between large institutions, but at the consumer level too. And the press has taken notice, and parametric has been covered not just in the Wall Street Journal, but also The Economist, with this relatively provocative title here, "The Future of Insurance is Happening Without Insurance Companies." That may be a long way off, but it's not completely beyond imagination. Jumpstart's product in particular, this is not a commercial for Jumpstart, but just as a way of context and a way of providing a specific exemplar of how a parametric product works for consumers. So it is a $10,000 lump sum payment after a severe earthquake, and I'll get into the trigger in a moment. And the average premium is $20 a month, and I'll get into how we derived those premiums as well. And it's this lump sum payment, no deductible. $10,000 in the United States is not even close to being enough to be a total loss coverage. It's only enough to cover a few months worth of expenses that are caused by the disruption of this exogenous shock. So it's really only meant as a jumpstart to the recovery process of the individuals, and that's why we named the company. So it can be used for any types of disruption, costs of disruption, same kinds of expenses that we saw from the exogenous shock of the pandemic, childcare, legal fees, transportation, any kind of thing. So the trigger we use is a severe earthquake as defined by the US Geological Survey. So that's a public data source, and it was very important to be able to choose this objective, transparent trigger so that both the insurance company and the insureds have equal visibility into whether the trigger occurred. And that builds trust in the parametric product and the parametric system. So this red zone of an earthquake is one that is severe enough shaking to cause macroeconomic disruption, but not so severe that it has to cause widespread destruction. So a magnitude 6.0 earthquake is about the smallest Richter magnitude that will cause this level of economic disruption. But it's not so much, like I said, that's like the movie San Andreas. A magnitude 6 causes a relatively small area. So this is probably 100 kilometers from the top to bottom. And a magnitude 7.0 will cause a red zone, a payout zone of probably 300 kilometers from one end to the other. The payouts can be triggered very, very simply. They're not completely automatic, because in the United States, at least, we need an interaction with the customer. As Jonathan said, this claim process, the insured has to actually initiate a claim. And so we prompt them, we say, okay, you're eligible to claim, you're in the red zone, you're eligible to claim your $10,000. Will you need the money, basically? And this is, and as soon as the insured person responds yes, then that constitutes the notice of loss. And then we initiate the payment that same day. And it's very different from traditional indemnity insurance. It's not meant as a substitute or replacement. It's only meant to help fill this protection gap, the gap of all the people who choose not to buy the non-mandatory earthquake insurance, which is earthquakes are excluded from regular property insurance in the United States. And it's meant to pay quickly. It's meant to pay for your unexpected expenses. The process is automated. The dollar amount of the payment is a fraction of the total value of the property, but it is on par with the incidentals that will always occur after this shock to the economy. $20 per month on average, $21 per month on average is about almost low enough to be an impulse buy for a lot of people, even people who make really quite a modest and median type of salary. So if we get right into the pricing, I'm sorry here, the map of California is cut off there on the west, but the pricing mirrors the seismic hazard, the probability that this trigger will be exceeded over the lifespan of the policy. So the policies are 1 year in length. We run a simulation, an earthquake modeling simulation. My background is in earthquake modeling, to be able to calculate loss estimates, both at the average level as well as the probable maximum levels, and develop a loss exceedance curve of the probability of exceeding the trigger at any given location. So we do that at a geographic resolution of a census block, which is basically equivalent to a city block. It's the smallest geographic unit in the United States. And then we aggregate those. So then at the census block level, we calculate on an annual basis, what is the average annual risk? What is the average annual payout at that census block level? And then we aggregate it up to the zip code level to be a little bit more fair geographically for the pricing purposes. And then there is a load factor to be able to pay the reinsurance company their operating capabilities and their functions, as well as the commission. And so it all aggregates up to, on average, population weighted average of $21 per month across Jumpstart's current portfolio, $20 per month across the population weighted average population of California. So now the lowest prices are in the Central Valley of California that have the lowest probability of occurrence of these earthquakes that cause severe shaking. And the highest prices, the highest premiums are along the San Andreas Fault that runs northwest to southeast, which has the highest probability of occurrence for exceeding the triggered payout. So if we zoom into the San Francisco Bay Area, which is on the upper left, and the Los Angeles Basin, which is on the lower right, we can see again, there's really only a few patches, a few of these zip codes that have the higher dollar amount. This zip code in particular is actually relatively unpopulated. It's in the mountainous areas. The couple of zip codes here are in a more populated area and have quite soft soils. So even compared to the zip codes around them, the probability of the earthquake being strong enough is about the same, but the probability of the shaking being strong enough is higher in the soft soil areas, because soft soil really amplifies the shaking. We have had one series of triggering earthquakes in Ridgecrest, California, which is way out in the middle of the desert near Edwards Air Force Base where the space shuttle lands. A magnitude 7.1 and a 6.4 in July 2019. We did not have any customers at that time in the payout zone. We do have customers there now. It really is a very remote area, but it did test the system and to show that the automation and the ability to connect to the data and use the data in an automated way to identify which insureds are eligible for payment, that system does work. And we started with earthquakes because, as I said, my background is earthquake modeling, but the notion of bringing parametric to consumers extends to all protection gaps, which in the United States will soon come to wildfire, and as Jonathan mentioned, is a very specific gap for flood. And with that, I'll pause and let's turn to the questions and answers so that we can have plenty of time for all of you.
Thank you for the insightful presentation on parametric insurance. Definitely not a new product, which is from what we see here in Asia, more commonly on crop insurance. So I think there was a question on whether it's similar to a capon, and I think Jonathan has kind of answered it, and it's not really it is more structured to be insurance. So I guess actually I do have a question in terms of like, it does seem that the success of your product is very reliant on a lot of data as well as apps that the clients would need to have so that they can just say, yes, I did have a damage per se, and then I get a payout from there. But do you think that would be a barrier to start in Asia per se? Because, you know, do you think it would be replicated in this part of the world?
Absolutely. I think that any parametric solution can be replicated. It's never going to look the same from one regulatory regime to the next, but the notion of set amounts triggered by objective data for the purpose of economic stimulus, the same principles apply, and you just have to work through with the regulators in order to figure out what is the most appropriate mechanism, that's the most appropriate regulation to protect consumers first and foremost, but also to allow innovation to happen. I see that there's a question here from me about the flat payouts. Do they occur once the triggers are met? Yes. Can the payout vary with intensity and distance? In theory, a product can be designed to have tiered payouts for different intensity levels. Our first product, because it's the first generation, does not have that, but it's absolutely on the roadmap. And another question, do you need to have financial losses in order to claim? In the United States, yes, that's one of the things, as Jonathan said, that really differentiates a parametric product from a financial speculation.
Right, I see a question from Chihak. Have analyses been conducted to test whether payouts are adequate to cover losses, or on the other hand, overcompensates? So with the way that we have been looking at this, when you do construction insurance for a project, you generally get a whole construction schedule. And from there, we can understand what on average is their daily burn rate of their expenses. And from there, we could really start looking at and structuring, and then we can make sure we are not going to be in a place that we are overcompensating. Now, you'll have conversations with the insured there to make sure that we're creating something that has the correct dates that they care about those coverages, the correct number of deductible days, as well as what is the day, what daily burn rate do they want. So let's say our analysis of looking at their construction schedule, we think it should cost, they're spending about 10,000 US a day. That means that the most we would be willing to insure them to is up to $10,000 a day. But as you're structuring these opportunities with the customers, you may get to a place where it's out of their budget, but $8,000 a day actually gets it into their risk management budget, and it fits properly. It's not perfectly covering everything, but at that point, it's mitigating a decent amount. So it's one of those places where we as insurance providers, we need to make sure we don't over indemnify. But when you're having these discussions with the risk manager, it's perfectly reasonable to get to a point where you're not fully indemnifying them, and they're aware of it and you're aware of it, because you're really trying to help plug a gap for them in their risk management strategy.
I think I'll piggyback off that. And one of the questions relates specifically to how we overcome the perception of parametric among regulators as being financial speculation. And it's exactly Jonathan's point of making sure that the payout amount is not over indemnifying, so that there is very minuscule chance of there being a windfall, so that almost in every case there will always be a shortfall, and that the insured party is aware of the shortfall. They're getting some money, but it's not going to make them whole. And then there were a couple of questions related to the data source. So first of all, I'll read the question from Philippe Domart saying, parametric insurance for NatCat has been piloted in mainland China by a number of Chinese insurers for several years already. Thank you for sharing that information. And it's sold over WeChat. Another question is are there equivalents to the data sources in Asia? So for example, for earthquake. So both the Chinese and the Japanese government each have their own agencies that develop earthquake data. For smaller countries, sometimes the earthquakes in smaller nearby countries are covered by the neighboring large countries. Also, there is an organization called Global Earthquake Model. It's an NGO that estimates loss estimates and publishes earthquake data to a consistent scientific standard worldwide. And I helped in the formation of that as well. And another question here related to the data: what is our experience in finding the objective data, and what's the quality and availability of objective data outside the US? I would say that it's honestly sort of chicken and egg. Parametric is best suited for perils or risks where there is objective data and both parties, the insurer and the insured, can agree on what that objective data source is. So if there's a peril that you want to insure and there is no objective data, then you got to think twice whether parametric is suitable for it. Jonathan, your comments?
That really covers it, Felder. Are there any other questions that you want that you see?
No, I think you guys covered all your questions, which thank you very much. Yeah, it was. Do you guys have any other further comments? If not, we could thank you very much for your presentations. I think we've learned a bit more about parametric and how perhaps we could actually replicate it here. Well, I mean, there are products here in Asia, like what Philip has said, but it is more towards like the more developed countries like China, rather than countries where we don't have like the farmers per se, and it's quite hard for people who have all the like the technology set up. Like you said, technology has spearheaded your parametric insurance. I guess we have one last question. I guess that came in. How are your reserves set up?
Or reserving setup? I mean, so in that sense, it's one of those places that until there's when you're starting off, you're going to really just look at what your expected loss ratios are. You also could really look at what is the length of a policy and understand how much reporting lag is, how much that is. So one thing that is nice, in my opinion, of these sort of policies is you're really not looking at, when you're thinking about your IBNR, you're not going to get to incurred but not enough reported, all those other little nuances versions of IBNR, at least the ones that I remember from my exams. We're not talking about real claim development. Like if we're paying $15,000, $20,000, $50,000, the cashier's check is sent, and at the end of the policy, if the policy is closed, there's really, not all that much claim development on a specific claim, especially once a policy is done. It's not like a GL or something else where we're going to see development 5 or 10 years on, or even longer in the US, so in that sense, there's a much shorter tail to really think about, if even in some places, beyond the policy or after 12 months, it's really, especially if you're talking about a 12-month policy, there's really no development there, because we know if an earthquake has happened, we know if, something else has happened. And then we're saying if A happened, we're paying you B. Once we pay B, there's no more to pay.
Awesome. Thank you, Kate. Thank you, Jonathan, for this morning. I know it's about very late for you guys, so thank you for
Thank you.
staying on. Yeah.
Thank you.
Bye.
Have a good day.